Hi, my name is Patrick Traverse and I am an investment advisor representative for the McDonald Tax and Financial Group, an independent holistic financial planning firm situated in Mount Pleasant, South Carolina. We help conservative families and individuals reduce their investment risk while giving them a reasonable rate of return. We are different from most financial advisors out there. We base our investment strategy on three main concepts: protection of assets, manage growth, while attempting to remove the emotional roller coaster investors get from being invested in the markets. This webinar is meant to explain why we chose our investment philosophy and why this might be very important to you. At the end of the presentation, there is also an offer you will not want to miss. So let's begin. In the last 30 years, there has been a decline in the number of companies that are giving a pension benefit. These days, the responsibility of retirement income is largely put on the worker's shoulders. If you ever want to live comfortably in retirement, you need to know how much to contribute to a retirement plan, how to invest the money, and how to turn this money into a lifelong retirement income. The problem is that most Americans are not doing a great job at growing their assets. There are three pieces of information I would like to share with you. This information was instrumental in creating our investment philosophy. The first piece is Dalbar's quantitative analysis of investor behavior. Dalbar, an independent market research firm, has been analyzing the effects of investors' decisions over the last 20 years. The analysis has shown that the average investor earns much less than the market performance suggests. In 2014, the 20-year annualized S&P 500 return was 9.85% per year, while the 20-year annualized return for the average equity investor was only 5.19%. A gap of 4.66% per year. The second element is the science of neuroeconomics. Neuroeconomics research how money affects our emotions and why investors make poor decisions. In a book called Your Money and Your Brain, Jason Zweig writes about many neuroeconomic studies. Zweig explained that the emotional roller coaster which investors are being put through during the ups and downs of the market causes them to sell near the bottom of a market drop and buy near the top when the markets are climbing. The book states that when investors are gaining in the market, happiness, greed, and confidence pushes them to take more risk. When the market is dropping, emotions like fear and regret force investors to sell their investments, possibly at the worst time. The sequence of return is the third piece that created our investment philosophy. This math theory explains the importance of lowering losses, especially near or at the beginning of retirement. Let me explain the theory. Let's say that at the end of 2004, you were 35 years old and had $100,000 in assets. You are in the contribution stage of your financial plan because you are not planning to take any money out of your account until retirement. During the 10 years between 2005 and 2014, if you were invested in the S&P 500, you would have seen your account fluctuate from $100,000 in 2004 to almost $126,000 in 2007. You would have seen some losses in 2008, but you would have been able to finish with almost $180,000 in 2014. The average rate of return for these 10 years would have been 7.84%. Now, what if we change the sequence of return? Would there be a difference in the final amount of assets we would have if we simply reverse the sequence? No. If you are in the contribution stage of your plan, as long as you average the same rate of return, you will end up with the same amount of assets at the end of the 10 years. Even if the lines of this chart look totally different, they end up at the same place. If we duplicated the same returns 3 times to give you an idea where you could stand near retirement at age of 65, we would have the same conclusion. As long as you have the same average rate of return, you will end up with the same amount of assets. That makes sense, right? It is simple math. Now, let's take a look at the sequence of return when someone is in the distribution phase. Let's say you start retirement at age 65 and you have $100,000 in an account invested in the S&P 500. The section of the table to the left shows the rate of return that the index had between the period of 2005 and 2014, which totaled an average of 7.84%, exactly the same as previously noted. Because you are in retirement, you decide to withdraw 5% of your account, or $5,000, and you increase this amount with inflation, which we assume to be 3% per year. At the end of 10 years, our $100,000 would be $86,512. We know that during the contribution phase, as long as you average the same rate of return, you would end up with the same amount of assets. However, in retirement, if you simply reverse the S&P 500 returns over the last 10 years, which should give us the same average rate of return, you would end up with a totally different amount of assets. In the distribution phase, the sequence of return does matter. If we repeated our sequence over a 30-year retirement, our findings are that if you have catastrophic losses early in retirement, your odds of running out of money in retirement increase dramatically. An investor that lost early in retirement would actually run out of money. Let me repeat it again. If you have catastrophic losses early in retirement, your odds of running out of money in retirement increase dramatically. The Dalbar's quantitative analysis of investor behavior, the science of neuroeconomics, and the sequence of return have molded our firm's investment philosophy. As financial advisors, our goal is to maximize our clients' retirement income while giving them the best chance possible at never running out of money. We understand that emotions can force even experienced money managers to take bad decisions. For this reason, we value the use of objective, rule-based investment decision-making, which takes emotions out of investing. We want to avoid putting investors through the market's roller coaster and give them a good chance at getting consistent returns with less risk. Now, let me explain how we are different. Most investment managers and financial advisors use strategic asset allocation. Here's the Callan periodic table of investment returns, which illustrates the performance of different asset classes and how they compare to each other over the years. As you can see, there aren't any single asset class that outperform all the others every single year. Depending on the year, they can be at the top of the table or at the bottom. With this in mind, the strategic investment manager diversifies portfolios within all asset classes and rebalances over time to spread risk and smooth out returns. At the McDonald Tax and Financial Group, we believe there is a better way. We have gathered a list of different tactical managers to help our clients invest. Tactical managers employ rule-based systems that analyze market data to define market trends. The goal is to help investors avoid catastrophic losses by modifying their allocation when trends change. Let me explain. Here's the S&P 500 performance chart for the last 20 years. The blue line is the fluctuation of the index end-of-day values. The red line is the trailing 200-day simple moving average of those values. By taking the average index values over the last 200 days, we are able to define a slower moving curve. A tactical manager uses this type of chart to learn market trends. If you look closely, the index end-of-day values indicated by the blue line spends most of its time above its 200-day long-term average. Tactical managers would label this as a safer time to invest in this index. However, a dip below its 200-day average would be considered risky, and the tactical manager would reposition investments to avoid the risk of catastrophic losses like in 2000 to 2002 and in 2008. Imagine if you were able to capture most of the upside when markets are less risky and only a small portion of the downside when the markets are very risky, how do you think you would have fared? How would you feel if you knew that a team of experienced managers is helping you avoid large losses in the markets? At the McDonald Tax and Financial Group, we believe that tactical management gives investors a better chance at growing assets over the long term to help them maximize their retirement income. It also reduces risk significantly to give them a better chance at never running out of money. Now, here's the offer I promised you. We are so confident in our investment management that for the time you will spend with us during a 2-meeting consultation to perform a second opinion of your portfolio, we will give you a $100 gift certificate. Just call us at 843-284-0370 to set up an appointment. You won't regret it.